Here's 5 things every first-time buyer must know before applying for a mortgage. Let's go. Hi, my name's Alex Kerr. I'm a qualified mortgage broker and my passion is simplifying the mortgage process and leading you to mortgage success. Let's get into the vid. 1. So all of these titles that you see, such as housing market crash, the housing market's going to crash, the housing market is crashing. What does it mean for a housing market to crash? Well, let's reverse engineer it. The opposite to a housing market crash is when rates are low and you are buying a property just before a boom, if you like. So at the point you buy a property, the mortgage rate is low and you are going to experience accelerated property growth over a sustained period. So a housing market crash is the opposite. You buy a property when rates are high and on the up and housing prices are on the way down or have come down substantially. A housing crash doesn't mean that property prices are going to lose all their value. It just means they're losing value. Now, buying property from the perspective of a first-time buyer or a homeowner is completely different to the perspective of an investor. A lot of investors buy properties and don't even own their own residential home. They see investment properties as an asset and homes that you live in as a liability, which is true. An investment property is designed to make you money. A residential property that you live in effectively takes money from you. But so does renting a property. Now, if you're an investor with a portfolio of properties and you have children, then you are likely going to leave them a nice little nest egg. But if you are not that fortunate and you don't have an interest in investing in properties, then owning your own home is the opportunity to pay off your mortgage and leave your children or future children with that nest egg. I wanted to make that clear as a lot of these housing market crash headlines do come from property investors. From your point of view, as a first-time buyer or homeowner wanting to move, I would be looking at the market through a different lens. The mortgage market has cooled off a little bit, meaning rates have come down after initially increasing after the Bank of England put rates up. But we don't know what is going to happen next. The Bank of England could put their rates up even more. They meet on a monthly basis and decide whether to put them up, down, or keep them the same. People say that we're going to experience the biggest recession we've ever had and rates are going to carry on going up from December onwards into 2023. The truth is we don't know. Recessions have always happened. The mortgage and property market, based on factual data, goes around in cycles. To keep it simple, boom and bust. There are good times to buy your first home and there are bad times to buy your first home. What that looks like really depends on how you view the market. When you buy a property for yourself or maybe your family to live in, you are looking to supply security to yourself and your family and your future. When you own your own home, you can make home improvements. There are no restrictions like when you are renting. And some landlords are very clever. They do let you do whatever you want to the property. Do it up, that sort of thing, as they will benefit because you do not own the property. So a mortgage is for 25, 30, 35 or maybe 40 years. If you look at the history of the housing market over 25 or more years, irrelevant of the market you are in right now, history tells us when you buy a home, within a 25-year period approximately, at some point during that period, the property you purchase will be worth double or more. That's based on factual data. So property market crashes and things like that, that sort of headline don't scare me. And that's me with a first-time buyer or homeowner head-on wanting to move or become a homeowner. Because I know if I buy a property today and it's worth nothing tomorrow, at some point within my mortgage term, the value is going to come back and more. And that's based on factual data from the history of the property market. So if you are a first-time buyer or homeowner and are wondering when to buy that first property or next property, I wouldn't base that decision on property prices, whether they're going to go up or down. The most important thing to home ownership from a residential point of view, which means being a homeowner occupier, is affordability. Now, at one point, the Bank of England base rate went up to 17% in 1979. If you purchased a property today and rates went up to 17%, you would lose the property. It would be repossessed. That applies to most of us and most of the people in the UK. Is that round the corner? I don't know. What are the alternatives? Renting, property investment. Property investment is more of a long-term thing. It doesn't help you if you want to buy property to live in next month. Renting. rent is increasing, the cost of living is increasing. I do think the one thing that this UK mortgage market is missing is long-term fixed rates. Now, that won't apply to all of you. You won't all benefit from a long-term fixed rate, and choosing a mortgage product is very specific to your individual circumstances. One rule doesn't fit all, but for the average first-time buyer who just wants to buy a home to live in and are able to guarantee that if rates did go up to 17%, it wouldn't affect you, then a long-term fixed rate with a portable mortgage option could be a solution for someone that fits that specific circumstance. A portable mortgage means you can take the mortgage with you if you move. So if you had a 10-year fixed rate and you moved home before that 10-year fixed rate had expired, normally you would receive a penalty to leave the fixed rate early. However, a portable mortgage allows you to move and take the mortgage with you onto the next home without a penalty. To be very clear, I'm not suggesting everyone take a long-term fixed rate. I'm just providing an example of a way a long-term fixed rate could benefit in a difficult mortgage market. Mortgage advisors exist for the purpose of recommending a suitable mortgage product to suit your specific requirements. If you knew you are getting an inheritance in 6 months that would pay your mortgage off completely and that's what you wanted to do, then a long-term fixed rate with penalties could be the worst possible option for you, as in 6 months' time when you get this inheritance and want to pay off your mortgage, you would have a big penalty to pay. Where if you choose a mortgage product with no tie-ins over a 6-month period, this could possibly be a better option for that circumstance. However, mortgages with no tie-ins are normally variable rates, which means the rate can go up and down. It can be more of a gamble. So as long as those rates didn't go up to 17% within that 6-month period, it would probably be the best option in that instance. So it's very important to understand your circumstances and what you plan to do long term, and then choose a product to reflect your circumstances. This is what mortgage advisors or brokers will do for you, and you may hear the terminology advice and recommendation. That's essentially what it is, advising and recommending a product. So the $1 million question, should you buy a property now in a recession or should you wait? I'm never a fan of waiting. How long do you wait for? I mean, you may get lucky, you may not. If you've got a deposit, a stable income, then my main thoughts would be not to max out the amount you can borrow. Make sure you can afford rates increasing beyond the point we are now. I would like to think that rates will never go back to 17%, but we've been sitting in historically low rates for the last decade or so, and we now face a cost of living crisis. If mortgage rates increase, so do rental rates, as landlords' mortgage payments will increase. And apart from owning your own home, renting is pretty much the only option that applies. So taking that into account, I would choose home ownership every time. If you would like help becoming a homeowner, we've got different options for you, from using our mortgage brokerage service to using our mentorship program. For full details, just go on to mortgagechain.co.uk, our brand new website. Prepare, apply, succeed. I'll see you in the next one. Mortgage warning. Please note, we do need to let you know that your home may be repossessed if you do not keep up repayments on your mortgage.